Hello and welcome to a new episode of Under 360 English channel. Today we are going to start another series that's on trading psychology. We know that when it comes to trading, knowledge is one of the most important factor you have to possess. So whatever approach you choose to based on your trading decision is on, be it fundamental or technical or quantitative or a combination of any of these things, you need to have a solid understanding of that particular approach. I hope all of you will agree with that. So apart from this knowledge, the other factor that is very important is the trading experience that you have to possess. Along with all these factors, one another important factor that you have to manage well, that is trading psychology. In this video, we shall primarily speak from the trader's perspective. First, we shall talk about the mindset of a trader. That is one of the most critical part of trading. As we told earlier, domain knowledge and experience alone are not sufficient to achieve a trading success. The third factor that is equally important is the trader psychology. You have to well manage the trader psychology, your psychology. Unfortunately, traders, especially those who are new to the trading, don't focus much on, or they are somewhat unaware of the psychological aspect and instead emphasize primarily on knowledge and trading strategies. But you have to keep one thing in mind, that to achieve trading success, it is very important to control your mind, and you have to ensure that the decisions you take are rational rather than irrational. Then now let's have a closer look on trading psychology. What is exactly the trading psychology? Well, trading psychology is the human mindset that in play before the trading or during the trading and after the trade also. If you have ever traded, you might have experienced various types of emotions, not only when you are in the trade, even after that also, about the loss, about the gain, and even before the trade also. Before the trade also, you might have undergone a lot of stress or strain, or maybe a lot of psychological stigma might have gone through. So how well you manage these emotions and separate success from failure, that does matter. You may wonder how trading psychology can be as important as having the domain knowledge and experience. Well, I will tell you a few examples. From that you will get a better understanding. First, let's take an example. Assume that there is an experienced trader and he spots a very good buying opportunity in a stock. He determines his entry level of that particular trade and stop loss and take profit level, in which levels you have to take or you have to exit from that particular trade. But if he is worried about a potential loss, sometimes he may decide not to get into that particular trade, and instead he may let the opportunity to pass by. This is what I told. Though some traders, they have the necessary skills to trade, unfortunately the psychological barriers that will prevent them from getting into a trade and to get the benefit out of that. In this case, that is the fear that actually prevented that particular trader from getting into that trade. Let's take another example. Let's assume that a trader, he has initiated the position. That means he entered into the position, and after he entered into that position or he bought a stock, assume that the stock started to move in his favor. But still he has that fear, or that drives him into a nervous stage. So what he will do, instead of waiting to get a complete profit, he will exit from that particular trade, and rest of the gains will be lost for his benefit. That means he has acquired the skills, but he was reluctant to believe his skills. In both the above examples, you might have noticed that how emotion got the better of the trader and prompted him to act in a certain way, which is ideally should not acted in. In the second case, if the trader could have adhered with the system that he had made, he could have got a better profits. So in both the cases, fear that prevented them from reaping better profits. Let's have a quick look on what are the emotions that generally any trader face during his trading. In the previous two cases, we almost thought like a hypothetical case, but here we are going to tell about something that even experienced or knowledgeable traders face when trading. In some cases, some traders, they won't execute a well identified trade setup because of the fear that he may incur a loss of capital. This is what happened in example 1. And in some cases, some other traders, they may exit a profitable trade early due to the anxiety that price may reverse or he may incur loss. Though he have a very well laid trading plan as well as the technicals may be supporting his trade. But because of the anxiety that develops within him, he couldn't be able to withstand that anxiety and exit from that position and lost his benefits. On contrary, just as an opposite, some traders, they hold on to their winning position for a long, even after that achieves the predefined target. Because of the greed, they hold that particular position, and sometimes the market may reverse and the entire profit may wipe out. And in some other cases, some traders, they go on averaging their losing trades, though their analysis, technical analysis says or that suggests that should not be averaged because that particular stock's price is breaching all the support levels. But still, because of the psychological attachment with that particular stock, that particular trader go on averaging the positions. This is another psychological adverse impact that generally traders experience. And on the other hand, some other traders, they may experience a string of winning trades and they become overconfident and they start to take greater risk than it's defined for them. So what eventually happens? A couple of trades, that itself may wipe out the entire profit, and sometimes that may take out some part of the capital also. Just the reverse may also happen. After experiencing a series of losing trades, the trader may themselves start to suspect his competency on selecting the trades. This is also a psychological barrier. So these are some of the most common psychological barriers that any traders face. Even if the trade is backed by solid research and analysis, one could still, they are susceptible, they are prone to the psychological barriers, and they may leave themselves for the decisions driven by their emotions. This actually led to a potential impede to your trading success. Hence, besides possessing knowledge and experience, it's equally important to gain control over your mind so that your decisions are rational rather than emotional. Next, we shall discuss about a few common forms of emotions that traders are prone to experience during trading. They are fear, greed, hope, and regret. First, we shall discuss about fear. So, fear is a very strong form of emotion that affects virtually all the traders, whether you are experienced or inexperienced. It is also one of the toughest forms of emotion to deal with when you trade. Even though an experienced trader might possess with a sound knowledge and have a good amount of trading experience, fear is something that can still impair his or her judgment and decision making abilities. I will tell you, even during when the trader has spotted a very good trading opportunity, this fear may prevent him or her from getting into that better trade. So when fear takes over a trader's mind, that could cause a trader to act in an irrational way and quickly succumb to the stress, which in turn could affect the trading success. So let's have a look on what are the various reasons generally triggers the fear to the traders. The first fear is the fear of loss. As there's a great deal of uncertainty over the time of entry, the fear of loss could arise before executing a trade itself. If you are fearful at the time of entering the position, the impact would be that may act like a chain reaction that will cascade once entered. A small price movement against that you have anticipated, that will make you panic, which actually in turn could affect your judgment with regards to not only the current trade but also the trades that you are going to take. This is the first fear for any traders they have. Don't think that you are an inexperienced trader, that's the main reason why you are experiencing the fear of loss. No, that fear of loss will be there for almost all the traders. How good you are, you can manage with the risk also. That's immaterial. The second fear is about the fear following a string of losses. Fear could also arise when taking a position following a string of losses. For example, if 8 of your last 10 trades went wrong, then even if you spot a very good trading opportunity, you may be hesitant to take that particular trade. Or in some cases, you may enter into that particular trade, but quickly you may exit by booking a small amount of profit. This is the fear that induced into you because of a string of losses. The third type of fear is usually we call it as FOMO, fear of missing out. This is especially common during powerful bull or bear markets. For example, if a particular stock has rallied strongly and everyone around you is buying that stock, you may pull the trigger. You may start to buy and decide to buy the stock by yourself, even if your analysis suggests that the stock is overvalued and is not worth entering at present. Apart from these kind of fears, some other fears like when your position size increases, especially if you are dealing with a small capital, and in some cases if you take some excess risk, all these things sometimes induce you a lot of stress as well as fear. So what sort of impact could fear have on your trading decisions? Well, sometimes you may cut your position of winning trades too early and book a smaller profit. And in some other cases, you may enter a trade prematurely for the fear of missing out a part of the price move. And in some other cases, you may enter into a trade very late because of the fear that you could miss out that particular stock's movement benefits. And in some cases, you may refrain from entering because of the fear of capital loss. Though sometimes you may feel that that particular stock looks good. And in some other cases, you may refrain from entering into a good setup because of some of your previous trades that was a failure. And in some other cases, your fear to lose your capital. Next, we shall discuss about the second emotion, that is greed. So greed is just the opposite of fear. Greed basically holds on to the trader's winning positions for too long, and generally that aims to capture the entire move despite of his trading system suggests that it is a better time to exit. So in order to get more and more profits, more benefits, the trader may hold that particular position to get more profit, but eventually the market may turn around and the entire profit may wipe out. Next factor that induces greed is nothing but the string of winning trades that make the trader overconfident and takes more risk and over trading. Eventually that may also wipe out the entire profits. In the case of fear, the trader takes no risk at all. But on the other hand, in the case of greed, the trader takes enormous risk, that too without any risk management backup. So greed is a common emotion that generally develops at the late of a bull market. As the price rally accelerates and become near to its peak, more and more participants join the rally because they have a sense that this is the place for an easy money. This kind of collective greed of all the market participants eventually causes the market to top up, and that reach the peak and comes down to the distribution phase, because overvalued markets cannot be sustained for a longer period of time. The fourth emotion is hope. Actually, hope, that's a very fantastic emotion. For example, you could hope to become rich one day. You could hope to become a successful trader one day, and so on. Okay. So in trading, however, hope might not really be the most ideal of emotions to sustain with. When you enter a trade, it must be based on sound trading setup, technical analysis backup you should have, and decision that you should make to enter into a trade, that should be very much rational. That should have a substantial justification why you should take that particular trade, rather than one based on the hope that price would move up or move down as you wish. Many traders, especially new traders, they just believe in hope and take trades. Basically, the emotion of hope tends to prevail the most among traders when they are caught in a loss-making position or have been stopped out but are still holding on to that position on the basis of hope that the current price move will reverse one day and allow them to cut down their existing losses, or better, exit at a gain itself. So generally, most of the time that won't happen and end up in a deep loss. So normally hope is a good thing, but still sometimes hope itself is a bad emotion sometimes that drive you to losses. The fourth emotion is the regret feeling. When all you will feel regret, sometimes you may have a regret feeling after exiting from a profitable position as the price continued to rise. For example, you bought Reliance Industries at 2200 and you booked the profit at 2500. After that also Reliance Industries went up. That time you may feel regret. In some other cases, after exiting the profitable position, you may have a regret that you could have buy more quantity. Instead of 10 Reliance Industries, you could have buy 100 Reliance Industries. Money to buy that. This is another regret feeling about the quantity. And in some other cases, after cutting your losses and then see a price reverse on that particular stock, and that price of that particular stock may go up. In that case also you may feel regret. In some other cases, you may find some very good trade setup. We may identify a very good stock and decided to enter into that stock. Unfortunately, the fear prevented you from getting into that particular trade, and after that that stock went up. This also causes obviously a lot of regret feelings in you. Apart from these four emotions, some small emotions like ego or overconfidence or frustration or anger, all these things decides the trading outcome many a times for any trader. But still, most of these tends to be somewhat similar to one or another variants of the four emotions that we have discussed earlier. Because overconfidence is a kind of similar to that of greed, while frustration and anger can be somewhat similar to that of regret. For instance, when you are in a winning position, the targets has been achieved. Your setup is suggesting that you have to book profit, and yet you are holding on to your position and bid to maximize the profit. Well, you already saw that behavior is because of the greed taking over your mind. Similarly, overconfidence could be another reason why you are holding on your position well beyond a reasonable time frame and well past a good risk reward ratio. As a trader, it is very critical that you control and manage these emotions and not let them affect your decision making than trading. Whenever you have a feeling that your trading setup is being overpowered with your emotions, at least you have to stop taking that decision there itself. At least pause your trades, stop your trades for that particular day. So now that you know the various forms of emotions that affect the traders, In the next sessions, we shall focus on how to manage these kind of emotions and how to control them, and to at the best how you can keep that away while trading, or in some cases at least how we can ensure that these kind of emotions have minimal impact on your trading decisions. So in the next episode, we shall discuss on some of the most common trading biases that traders are generally experiencing. There comes the end of the first episode in trading psychology. See you in the second episode. Till then, bye from Anu.